In a classified balance sheet, companies group similar assets and similar liabilities together as they have similar economic characteristics. The groupings help users to determine 1. Whether the company has enough assets to pay its debts, and 2. The claims of short and long-term creditors on the company's total assets. A classified balance sheet generally contains the following standard classifications: current assets, long-term investments, property, plant, and equipment, intangible assets, current liabilities, long-term liabilities, stockholders' equity. Current assets are expected to be converted to cash or used within 1 year. Here is an example of the Assets section of a classified balance sheet. Here is an example of the Liability and Equity sections of a classified balance sheet. Long-term investments are assets not used in the operations of the business that will be converted to cash in more than 1 year. Property, plant, and equipment includes assets with long useful lives that are used in the operation of the business. Intangible assets are rights, privileges, and competitive advantages that result from assets that have no physical substance. Current liabilities are obligations that are supposed to be paid within the coming year. Long-term liabilities are obligations expected to be paid after 1 year. Stockholders' equity is the stockholder's net claim on total assets. It has 2 components: common stock and retained earnings. In Chapter 1, we introduced the 4 financial statements and discussed how they provide information about a company's performance and financial position. Now we will present ratio analysis, a tool that can be used to analyze financial statements in order to make more meaningful evaluations. Profitability ratios measure the income or operating success of an enterprise for a period. Creditors and investors are interested in evaluating profitability. Profitability is frequently used as a test of management's effectiveness. Earnings per share is computed by dividing net income available to common stockholders by the average number of outstanding shares of common stock. An analysis of the relationship between a company's assets and liabilities can provide users with information about the firm's liquidity and solvency. Liquidity refers to a company's ability to pay short-term obligations as they come due. Working capital is equal to current assets minus current liabilities. Current ratio is equal to current assets divided by current liabilities. Solvency refers to the company's ability to survive over the long term. Debt to total assets ratio is equal to total liabilities divided by total assets. Investors, creditors, and others want to know about a company's most liquid asset, its cash. The statement of cash flows provides financial information about the sources and uses of a company's cash. To aid in the analysis of cash, the statement of cash flows reports the cash effect of a company's operating activities, investing activities, and financing activities. Operating activities. This section of the statement of cash flows presents inflows and outflows related to the primary operations of the business. Analysts have noted, however, that cash provided by operating activities fails to take into account that a company must invest in new property, plant, and equipment and maintain dividends at current levels. A measurement to provide additional insight regarding a company's cash-generating ability is free cash flow. Free cash flow is equal to cash provided by operating activities less capital expenditures and cash dividends. Retained earnings statement describes the events that caused changes in retained earnings for the period. Statement of stockholders' equity reports all changes in stockholders' equity accounts, including issuance of common stock, retirement of common stock, changes in retained earnings. The basic objective for financial reporting is to provide information useful for decision-making. Generally accepted accounting principles are the agreed-upon accounting rules which most U.S. companies use in preparing financial statements. In order to be useful, financial information should possess the following qualitative characteristics: relevance, reliability, comparability, and consistency. Relevance. If the information has the ability to make a difference in a decision scenario, it is relevant. An item is material if it can influence the decision of an investor or creditor. Reliability. If information can be depended on, it is reliable. Comparability. In accounting, comparability results when different companies use the same accounting principles. Consistency means that a company uses the same accounting principles and methods from year to year. To develop accounting standards, the FASB relies on some key assumptions and principles. The preparation of financial statements relies on the following key assumptions and principles. Monetary unit assumption states that only transactions expressed in terms of money are included in the accounting records. The economic entity assumption states that every economic entity can be separately identified and accounted for. The time period assumption states that the life of a business can be divided into artificial time periods and that useful reports covering those periods can be prepared for the business. Going concern assumption assumes that the business will be in existence for the foreseeable future. Cost principle requires assets to be recorded at their original cost. Full disclosure principle requires all circumstances and events that would make a difference to users to be disclosed.